Welcome back to PeezyFX Trading. And today we're going to touch on liquidity and the aspects of it. So as you can see, I have a period of consolidation marked up here on my charts. And I have support and resistance. What support and resistance basically is are liquidity pools. Now, retail traders place sell stops under lows here, and they place buy stops above highs here. And they also place buy limits down here, sell limit orders up here. They have their stop losses above here, stop losses below here. So this is what these dollar signs represent, is their stop losses. Now, our focus should always be in this area. However, we should be monitoring this area and not trading it. What we do is we wait to see a reaction. And when the reaction occurs, we want to see those equal highs and lows be taken out and then look for our opportunity to get in the market. This is because retail traders see equal highs and equal lows as support and resistance, which they see these as beautiful trading opportunities. And yeah, it works every once in a while. It works every once in a while, but eventually they're going to get taken out. So they put pending orders at this area or take a trade early at support and or resistance due to retail traders seeing a previous reaction off of that area. This then builds liquidity in the market for banks to use to move price. The longer, like this consolidation carry on for 56 days. So the longer a support or resistance had been holding for, the more liquidity would be valid in that area, which then leads to an impulsive move created by the interbank traders. And the highest probability of liquidity areas are going to be above previous weekly highs and lows, as well as daily. The highest probability liquidity areas are above weekly highs and lows, but daily as well is like the second most. These green highlighted areas that I have here are considered liquidity pools. It's where a big pool of stop losses are resting, and you want to be targeting them areas. You want to target them. Therefore, if you see equal lows here and here, you want to be trading something like this: expansion lower, pull back to trade lower, taking out equals. You don't want to buy when you have equal lows over here. So just say price is coming down here and you're trying to buy because it's done reacted from this level so many times. As soon as you see the equal lows right next and below your entry, that should automatically invalidate your trade setup. Buy and sell side liquidity are generated from support and resistance, and it creates liquidity pools. Liquidity pool is an establishment level in the market where stops and orders would be resting, leaving these areas exposed for smart money to hunt, taking out stop losses and triggering new buy and sell limit orders that may be present in that area. Buy stops and sell stops are sources of liquidity above and below short-term and long-term highs and lows. Liquidity can also be engineered, meaning the bank's algorithm, to create equal short-term highs and lows. And they create these relative equal highs and lows, or just flat out equal highs or lows, for them to generate liquidity and then target that same liquidity. And as soon as the liquidity is taken, it's either gonna continue down or it's gonna immediately reverse. It's called a purge of liquidity. Now, buy side and sell side liquidity. This down here would be considered sell side liquidity. This up here, considered buy side liquidity. Okay. Now, these are areas of price in which buy stops or sell stops are mostly residing. When we understand the higher time frame, then we can see where smart money is possibly going to go long or short due to areas of price creating support and resistance. Price will use these areas to seek liquidity in order to reverse or continue with its expansion move. So, sell side liquidity here, that is obviously where the banks were targeting during this liquidity pool here. They drove price up one final time, reacted from this order block, and jammed price down. As soon as it took out liquidity, it continued on in its previous direction where price was going up. It went up, and this was just a correction to generate liquidity and continue up higher. When price is making a double top at a resistance, retail traders see this as a sign to go short, which in most cases, a majority of the retail traders entered the market too early. Price takes out equal highs, triggering the stop losses on early sellers, and most importantly, triggers the buy stops to pick up liquidity, then moves in the intended direction. Similar applies in the opposite scenario with double bottoms. Now, think about it like this. How many times have you been trapped or took a loss from a setup similar to these scenarios? It happens to retail traders over and over again because they do not understand the reasoning behind the setups. Most retail traders are taught to buy a double bottom and to sell a double top. Now that you understand these patterns and how market makers use them, you will be able to see these manipulated moves occur. And then you can enter the market after the manipulation is complete and you have confirmations to enter. So I'm going to show you an example where you have a double top here. You have double tops, and then the market comes down and jams price up. When it created this double top here, that generated buy side liquidity. When price jammed up, taking out this liquidity, this is when you will be looking to go short. you have this is what we call an order block. Now, this order block here is the candle that took out the equal highs. And what really confirms this order block is what happens next. This here is a bearish engulfing candle, or whatever you want to call it. It totally engulfs the order block. It's a bearish candle that engulfs the order block. That is confirming your down movement right there. Now, what you want to anticipate after that is a retest. And you want to anticipate on price coming up into this candle here. Also rebalancing and redelivering price up into this down day here. Now you can take your fibs and go from this high to this low. High, low. Oh, I'm sorry, it's here. High, low, pull back into the order block. 50% is the equilibrium between this dealing range. Now, the majority of the volume in this price swing, it would look like that, the same. So it really don't matter if you use the wicks or not. Sometimes it does, but most of the time it doesn't. So basically you have your dealing range here. After this transpires, you want to keep an eye on the low of the order block and the 50%. That's what you want to keep an eye on right there. And your entry would be resting somewhere around this area. Just say you put it at the open. Bring your stop loss resting right above 50% of the order block, especially on a higher time frame. But when you're on a lower time frame, this same thing occurs to every single time frame, guys. Price is fractal. All these patterns play out on every time frame. But when you're on a lower time frame, you want to be sure to cover your order block with your stop loss, either the high of the order block or the top of the body. But when you're on a daily and weekly time frame, you want to put it just above 50% of the order block. Now, as you can see, price trades down, rolls back up, and touches it there. Look, the opening of this candle right here is 1.18704. The high of this candle right here is 1.1868. So 1.1870, 1.1868. Now that is literally 2 pips away. 2 pips away. That is not a coincidence, guys. And then price trades down, opens. And what's going on here is we have another liquidity purge. Price opens, trades up, taking out previous day's high, digging into this order block deeper. and then trades down for 100 pips. Now, when you're on a daily time frame, these setups can be amazing. So price takes out equal highs, activates buy stops, and then moves lower. Now, that's pretty much gonna wrap up the lesson on liquidity. There's not really much to it, but at the same time, it's the most important thing, because price is going to chase two things, guys, and that is liquidity and imbalance. That's it. Now, until next time, guys, good luck and good trading. Peace out.